Hey, welcome back. I'm Rick DiBiasio from Latitudes Financial Strategies, and I've been professionally helping people retire since 1985. So it's like 35 going on 36 years. We're here in early 2021 as I record these videos. And I think we have something that's going to hit us in the next anywhere from 1 year to 5 years as we're doing retirement planning that we need to be aware of, because I think it provides a substantial risk to many retirement portfolios. Let me tell you about it. Okay, let's back up a little bit. Last week, or last session, I told you about the bins and gap method of investing, which is a way that we provide a potential lifetime income with your retirement assets. And we remove 5 years of cash flow from market fluctuations by putting in safe, low-yielding investments. But we know that the rest of our portfolio then is not affected, so we can take a proper long-term approach to investing with the rest of our money, knowing that our cash flow for retirement is for 5 and almost 10 years pretty much already set aside, so we don't have to worry about that. Well, let's talk a little bit about how investing works in general now and what's happened in my industry during these 36 years that I've been doing it professionally. And honestly, I've been investing since I was 10, so it's more like 55 years of investing. But there's a lot of different kind of risk, and I named a few just off the top of my head. You know, company risk. If you invest in a company and say it goes out of business, well, then that stock will end up being worthless. And currency risk, if you invest in a country like, say, Venezuela, and then their Venezuelan currency, gets hammered because of politics, then that's a problem, and so on. There's political risk, there's inflation risk, there's economic risk, and I don't want to beat this all to death, but just the idea that in any investment we make, I feel like the first thing you need to do is identify what can go wrong with it. What's the risk? Because if somebody says an investment is guaranteed, well, who's guaranteeing it? Just because somebody says it's guaranteed doesn't mean that it's appropriate for your investment strategy. So the big one we want to talk about in this module is interest rate risk, and I'll show you why I'm fairly concerned about it. In my industry, for the last 40 years or so, but almost more now, we've all become enamored in my whole entire business model, not me so much as the rest of the industry, with this thing called modern portfolio theory. And Harry Markowitz in 1952 wrote a paper on this, and he also won a Nobel Prize in economics. And I can tell you that if you go in any investment office right now, you're going to find out that they're probably got some type of basis of what's called an efficient frontier. And you've probably seen this. An efficient frontier shows you that the amount of risk that you're assuming and what your hopefully expected return is. And the idea is that you will find some place on that curve where you will meet an acceptable return for what you need in your portfolio and take an acceptable amount of risk. In fact, I even have a software where after I've put together a whole portfolio, I hit a button saying optimize, and it will help to take out some of the more excessive parts of the portfolio so that I can get a better potential return than I would if I had invested the way I originally wanted to invest with less risk. Now, does it always work? No, because all of these things in investing are based on projections and hopes. And it's awfully hard to do a lot of math when the underlying assumptions may be wrong. And I think that's what's going on in the investment world right now. So I really think this is important. If you'll notice on that slide, and depending on what device you're watching me on, if you're watching it on a phone, it's probably impossible to see. But you can see that as we get lower to the left on this investment, you'll see that it's a combination of bonds and stocks. And that's pretty much what everybody in my business right now wants to do, is have some type of diversification so that your money's spread out. And diversification is fine. It may or may not give you what you're trying to accomplish. But the point is that by having a diversified portfolio, you can diversify away some of your risk. In fact, if you look there, you'll see that the 100% bond portfolio down here is actually slightly riskier than the 75% bond and 25% stock portfolio. That's all well and good. That's all fine, but we're not investing in a vacuum. Things change over time. And I want to talk to you a little bit about those assumptions that we make. You remember Sir Isaac Newton, the guy who discovered gravity? He was the most famous scientist of his time. While he was alive, people knew who Isaac Newton was. He was the Einstein of his day. And he got hammered not once, but twice by trying to invest in the stock market. He felt like he was smarter than everybody else in the room. And as the article I have referenced here in the Atlantic from a few years ago says, it makes me laugh every time I read it, he lost all reason in the pursuit of riches. And due to the South, what was called the South Sea Bubble, and we don't have time to do all that right now, but Newton said, I can calculate the motions of heavenly bodies, but not the madness of people. And I think when we try to get too locked into these themes or these formulas to try to invest, we're often disappointed as investors because the market has so many variables that you can't make a game of it. Because as soon as you make a game of it and think you've got something figured out, then another part of the market pops up and changes the rules. So the rules are always changing in investing. So math is nice, it's a nice guide, but I think right now we're getting things wrong as an industry, and here's why. When interest rates rise, bond prices fall. Okay, and I'm going to explain that in a little more detail in a minute, but you need to know that, okay, that if you're holding a portfolio of bonds in your retirement account, and if interest rates go higher, the price, the value of your bonds that you could sell them for on the market that day will go down. That's just like science, okay? That's not an investment opinion. All other things being equal, bond prices react to interest rates. Okay, so right where have we been? Well, interest rates are pretty low, right? Here's a rate, the rate of 30-year treasuries going all the way back to like 1980. And this chart stops in about 2016 because we stopped issuing 30-year treasuries. But you can see that it's pretty much straight down like a ski slope. In fact, if you look at a much longer period of time, like look at long-term interest rates all the way back to 1790. And you can pause the tape here and look at this, or just look it up on Google Images, you'll find this chart. You can see that we hit an awfully high place in interest rates during our lifetime. If you're a baby boomer like me, during the beginning of our career, you probably remember, all the layoffs and all the problems when Paul Volcker raised interest rates so fast because he wanted to fight inflation. That's why rates go up, mainly because when you're a bond holder, when you hold a bond, you want to get your money back. You're not really trying to build wealth with bonds. Usually you're just trying to loan your money to somebody and you want to get back your money plus the purchasing power that you lost due to inflation over time. So as inflation becomes higher, so do interest rates. Well, interest rates were really jacked up by Paul Volcker in 1980 because, remember the win buttons, Jerry Ford win buttons, right? So what happened was that those rates got very high, then they started to come back down. And they basically come down for all of our careers. We're to the point now where, and this is what I said in my book, The Retirement Dilemma, and the dilemma is that interest rates are close to zero and the stock market is close to record highs. Well, why did that happen? Because Volcker jacked the rates up. They've been coming down pretty much ever since. And then we had the financial crisis in 2008. And these things take a long time to fix themselves, right? And then about the time we're starting to see rates get ready to go up again and the economy's starting to do well, the coronavirus hits. And what happens? We see rates lowered again. And how does the rate get lowered? The Federal Reserve just floods the economy with money. They send out a lot of money. They make loans very easy to get and at very favorable rates. And that's where we've been. Well, once we get beyond this pandemic, we will have to do something about these long-term rates. And it's called reflation. So we're going to see interest rates go back up as the economy is reflating from all this money that the Fed has pumped in. And then we've also got rising commodity prices, rising wages, and the Fed wants to return to a more normal footing. And they've said within a year to 2 years, they plan to start looking at that. Right now, we're okay, in January 2021. But we see that at the point we're at now, we're at emergency levels. The Fed is going to want to get back to more normal rates so that if something happens to the economy again, they haven't used all their ammunition. They have the power to cut rates again. And that's how the cycle works. So we're probably at a point where somewhere during your retirement, perhaps early on, you're going to see rates go higher. And the effect of that on investing can be devastating to your portfolio. We've had a few little blips of rising interest rates. I think we had one in 84 that I remember. I think we had in 94 we had one. We had one, a little scare in 2017 where the Fed tries to raise rate and the markets went nuts. So that's what happens is we get these interest rates that are artificially low to get us out of trouble, and now they have to go back up. And when they do, there can be a problem. Let's play that old favorite party game, who'd you rather? If I sent you to the store right now with a couple of $100 and said, go buy me a bond, which one would you buy me? Well, I hope the 6% bond and not the 4% bond. All other things being equal, if they were from equal creditors and equal duration, they both were, say, 5-year bonds, of course you'd buy the 6%. Otherwise, I'm not sending you to the store for me again, right? So that's what happens to the marketplace. So when you have a portfolio of bonds that are paying record low rates, but they're 5-10-year bonds, but they're not even paying 1%, what's going to happen to the value of those bonds? Who's going to want to buy them when they can maybe buy bonds in the new rate environment at 3 and 4%? Well, people will still buy them, but they'll pay just a lot less to get them, so that by the time they get back to maturity, they've made pretty much the same amount of money that they would have at the higher rate. This can be devastating, as I said, to bond portfolios. So in my firm, when we're starting to design portfolios with that efficient frontier in mind and with wanting to optimize our portfolios, I'm being very, very careful about the type of bond exposure that we have, because if rates go higher, it's going to be ugly. Now, remember, bonds are loans, so they're not stocks, right? There are exceptions to this, and we're not going to get into it right here. But normally, when you buy a bond, you're agreeing to loan your money to a government, to a municipality, to a company. When your bank gives you a mortgage, that's basically that's a loan, that's a bond as well in a sense. So that's all bonds are. So normally in a retirement account, we put bonds in to lessen the risk, the volatility of a portfolio compared to all stocks, and because we want to maybe generate some income from it. Now that's changed a little bit because the income is so low right now that it's become a problem as far as that's concerned. Well, think about it in the context I just gave you of historically low interest rates and what happens when they go back up. So rising rates may hurt your bond portfolio. I'm going to say they will hurt your bond portfolio. I can't come up with many scenarios what they won't. And I'll tell you something else. Let's say I'm wrong, right? Let's say that interest rates don't go higher. Well, that means the economy is still doing pretty badly. And that means that really not a whole lot of financial instruments are going to do very well. So I think you will see a gradual increase in interest rates, provided everything else from this recovery from the pandemic takes effect. You'll see rates go higher. And in the long run, higher rates would be okay. I could live with that. If you came into my office and it was like it was when I started in the industry 30 years ago, and I could lock up some of your money guaranteed at really nice rates, that'd be terrific. I'm all for that. But that riding that wave from very low to higher with existing bonds can get you beat up and beat up pretty bad. So you need to be aware of that. So of all the risks out there right now facing our economies and facing portfolios that I manage, one of my biggest concerns is that as inflation returns, as the economy begins to do well, then we are going to see bond prices get beat up. Like I said, bond prices can go lower as interest rates go higher, as we reinflate the economy and as inflation becomes an issue again. So keep that in mind. I don't mean to scare you, but I'm saying that if you own a portfolio now that is dependent on the traditional mix of stocks and bonds, then take a look at those bonds and see whether you think they'll weather a rise in interest rates, depending on the kind that's in there. And perhaps you want to get to a point where you either have less bonds in general or maybe shorter term bonds so that you can play this rise in interest rates and not get beat up as that happens. So it's not something that you're going to hear from everybody who's managing money right now, but it's something we all ought to be aware of. And I'm certainly concerned about it for clients that I work with now. We want the volatility of preserving assets that come with bonds, but we don't want to see money principal get beat up by an increase in interest rates. So hope this helped. We'll see you next time at the next module. And go to our website, latitudesfinancial.com. Be happy to help you out if you would like to set up an appointment right on my website to talk to me by phone. Thanks. Hope this helped.